Hello and welcome to my first in-depth video covering imbalances. As usual, I'll keep everything very simple, so it is easy to understand for all beginners. Now first you need to understand that imbalances have different names across the trading community. They are known as inefficiencies, fair value gaps, liquidity voids, and imbalances. Imbalances are mostly used in the crypto market, fair value gaps are used for indices, inefficiencies are used in the Forex market. Now, what is an imbalance? In the simplest terms, an imbalance is created when one side overpowers the other. So for example, sellers are known as supply, while buyers are known as demand. So when the supply overpowers the demand, as in this case right here, the sellers cause a strong push to the downside, which leaves gaps in the price like these two, where there wasn't any demand or buyers. Of course, you will see pauses in the market such as dodgy candles, shooting stars, hammers. The price will often try to rebalance the market by retracing, but it won't always manage to fill every single gap, depending on the strength of the trend. In this case, we have a strong downtrend, and yet the price was able to efficiently rebalance every gap left behind. If we are to look closer, we have this imbalance, then we have this imbalance, and then this imbalance as well, which were all efficiently filled. As the price broke out of this range, it caused a strong movement downwards. But price retraced and was able to fill the gap partially. You have to keep in mind that price won't always fill gaps immediately. Some gaps or imbalances can take up to days or even months before they're finally filled. Now, how exactly do we find imbalances? The most basic way is by finding a group of same colored candles, like in this case. Then you would look for some of the biggest candles that simply don't have neighbors. You can look at this candle, for example. It has a neighbor here and a neighbor here. But then this candle right here doesn't have a neighbor on the right nor on the left. And the way we find the imbalance is by marking the zone from the left candle's wick to the right candle's wick. From the left candle's wick to the right candle's wick. Which in this case we can see that the market managed to rebalance the price before dropping lower. It is not 100%, you shouldn't expect 100% fills all the time, especially in a strong trend. And it's a good thing to keep in mind, as this gives you a heads up of the strength of the current or upcoming trend. Second method to find an imbalance is by using the profile tool, which we can find usually under the long or short positions tab, all the way at the bottom. With this, we can mark out the whole move, and this will show us a histogram. These are my settings. I increased the row size, disabled this and that here and there that I didn't find needed. And then the way we use the profile tool is by marking areas in the histogram where price was very low. Like that, this right here, and that, and this. And by extending it more to the right, we can cover the whole area and take away all the imbalances that are no longer valid. As you can see, the previous two imbalances here are now filled. And what we have left, it's a possible imbalance here and another one right here. Using the profile tool though, as you can see, the logic of using the top and bottom wicks of neighboring candles isn't working anymore. But this is based on your trading style and however you prefer using or combining methods and tools. Another way we can use the profile tool is by using them on very big imbalance candles. This way we can pinpoint wherever the actual imbalance is. As you see here, we have a massive candle, but we have two major imbalances. And by major, I mean that there's barely any volume in this area and in this area right here as well, compared to areas such as this one and this one. Areas where there's little to no volume are stronger imbalances. As you can see in this example right here, price just barely tapped this imbalance and filled it. Now if you would think using the wicks of the candles, it also just barely tapped inside the imbalance before dropping lower and continuing. Now the last manual method to pinpoint an imbalance is by firstly finding the move that caused an imbalance and then heading to a lower time frame where you can find the actual imbalanced candle. Like in this case, we have an imbalanced candle right here, one here, another one here as well. Price again did a strong move and managed to fill two of the imbalances in this area. On the lower time frames, price is constantly creating gaps and refilling them. Here we're on the 4 minutes chart. The price is constantly creating imbalances which are filled within the day or minutes later. Now price action is full of gaps and you need to know which imbalances to use as your point of interest and which to avoid. And that is mostly based on the trend direction, which in this case it's an uptrend, but at the same time we are ranging because we are unable to make higher highs. Now let's see how we can use imbalances and why we have to trade with the trend. In this example, we have a range. As you can see, price is constantly creating imbalances, which are constantly getting filled 100%, meaning that we cannot use them for entries. While it might work in a few cases such as this and also this for short-term trades such as scalps and day trades, it is better to trade following the trend. To find the trend, we can either use a simple trend line or break-up structure, which I've discussed a couple of times in my previous videos. These arrows mean that the market is constantly creating higher highs, which means the price is trending, breaking previous highs and creating new structures. And in this case, this is known as a change of character because price went against the trend and broke to the downside. I recommend having a higher time frame to find your bias and a lower time frame for your entries. For example, I mostly use the 15 minutes or the 1 hour to find my current bias, like the direction of the price, either to the upside, downside or sideways ranging, and the 4 minutes or even the 1 minute for entries. And another thing to note is that if you are in an uptrend, you should only take trades that are in discount areas and avoid setups in premium areas. The discount area is the lower part of a swing, while the premium area is the top part of the swing. This right here being our swing. In this case, we have a simple imbalance right here, which was quickly filled within a few minutes. But this could have given us a good entry for a long setup. While in my example I used a lot of rectangle boxes, I prefer to use the Fibonacci tool, which I've edited to give me levels of the imbalance. In this case, price action filled the whole imbalance, but this would have still been a good long setup. One good advice that I have for you if you are an imbalance trader is that to always try to cover your supply or demand zones, as if the trend is not all that strong, price would often go all the way back to a demand or a supply zone before continuing in its original direction after filling up the imbalance. So in this case, we could enter in the imbalance at either level of our Fibonacci, which by the way, this is the middle one is the 50, the golden one is the 61, and the lower one is the 78. We could enter at the 61% of the Fibonacci and attempt to cover the demand zone that caused the initial big push and imbalance. Now we could go on a lower time frame, since as I mentioned I use the lower time frame for my entries, like the 4 minutes. And here we can see that the demand zone is right here, not all the way down here. So I'll put my stop loss somewhere around here. In this area, the price is efficient. There's no imbalances, so the price is more unlikely to head all the way down. And as we talked earlier, we can snipe imbalances on a lower time frame compared to a bigger time frame, which would give us a better entry as well. Like in this case, the imbalance is not all the way until up here, but it's actually right here, from this wick to this wick. So again, our entry could have been at the 60% of my Fibonacci. Stop loss under the demand zone, which you should also mark so you can remember which the demand zone is. And our take profit can be at the top of the previous swing. Unless you are a bit more daring, you can go a bit higher as well and use the trend-based Fibonacci to find the next levels where the price may head. Like for example, the 127 would have been a good example in this case. As you can see, price went all the way up, just barely broke through the 127 and then changed direction. This might be a bit of more information than I was supposed to give in this video, so I'm hoping I'm not confusing the beginners too much, but just take notes, and in the future I'll be making videos on each topic and you will get it better. So in this case, when I've had a good win, I prefer to trade from demand to supply, supply to demand, and so on. Now, if the trend is not all that strong, the price could retrace all the way down to the demand before continuing higher. But in this case, price only hit the imbalance and then continued higher, which is a sign that the trend is pretty strong and established. Another tip I have for you if you plan to become an imbalance trader, or if you are an established one already, you may already know this, but you can use failed areas of demand or supply, which were broken by a strong move, as possible entities and points of interest. This right here is a failed supply zone, which caused a pretty good move, but then it was broken by the price with an even stronger move, which caused a change of character and an uptrend. After the uptrend got broken, the price headed down to fill any imbalances remaining. And as you can see, the only imbalance left was right here. The price was then manipulated and dropped all the way down to this level where there was this imbalance, which also had a failed supply zone. Price stepped into this imbalance and supply zone and then caused a major explosion. This being an imbalance that was left behind for many hours and even a day, a lot of orders were accumulated in this area, which caused this explosive move, which of course in its turn left a number of imbalances behind as well. Now keep in mind, if price ever comes to an imbalance and it ignores it, such as in this case, where price was heading downwards, filled up this whole imbalance and then headed lower and then broke right through it. This is a confirmation to you that the next trend is strong and you should change your bias. If in this case you were bullish, now you can definitely be bearish. What a move that was. Now back to this failed supply zone and imbalance that was left behind for a number of hours. As I mentioned earlier, you would always want to cover the demand zone that created this imbalance. So if you were to enter right here, you would want to also cover this demand zone because price could push down into it to grab any orders that were left behind before continuing higher. Now, imbalances are actually mostly used for targets, not for entities. Most traders I know would use either a supply or the demand zone for trades, but in this case I personally would have used this imbalance because it had the failed supply zone behind, so I would have also used this, while my friends would have used the demand zone, which wouldn't have worked in this case because price didn't push all the way down. But again, most traders actually use imbalances as points of take profit. Like in this case, for example, we have an imbalance right here which was left behind. It was wicked into before price continued lower after the break of this range and change of character from this uptrend. There was still a considerable gap left behind. One last thing I want to mention, which some people might have a different opinion on. When I started trading, I used a lot of indicators. And for a long time I wasn't really getting anywhere with them, but then I found indicators that have helped me identify my targets easily and improve my skills. Like in this case, I'm sure many of you already noticed this indicator up here, so I'll also give you this indicator. I hope you are not gonna use it blindly and use it for the purpose of learning instead of simply trading with it. You'll find this indicator for free called Fractal Break Imbalance Fair Value Gap. As I mentioned, they have different names from different markets, but they all mean the same thing, made by Gene Clash. If you just write the whole thing like that, it will be the only that one that appears. Now this indicator is good because it will show you which imbalances are within a range and which imbalances were caused by a strong move or break of structure. We'll look at our previous example of the trend. As you can see, it's really showing us every imbalance you can find, which you need to learn how to filter imbalances and only go for bigger and stronger imbalances than every single possible imbalance available. These are the settings that I have for the indicator. Nothing fancy, nothing amazing. I just like to keep it clean. What does everything mean? The yellow boxes mean that there wasn't a break of structure, while the red boxes mean that there was a break of structure. As you can see, there's this dotted line right here at this low. The price created this low, went up, created a high, and then dropped, breaking this low and creating a intermediate lower low. While the green boxes were caused by a break of structure to the upside instead, which in this case would have been good for us because we're in an uptrend. I mostly use the indicator just to find imbalances to improve my eyes, so I can find them easily, even the smaller ones such as these. Any other reason I didn't really use it, it's also good because it helps you tell the current market structure. If you are seeing a lot of green lines, that means you are in an uptrend. If you are seeing a lot of red lines, that means you are likely in a downtrend. And that was it for this guide and introduction to imbalances. I apologize if I'm rusty in my explanations. This was my first long video and I'll definitely get better in the future. With this chance, I would like to thank you for 5,000 subscribers and let's keep it going. This will be the start of long videos, which will be covering every topic I covered in my short videos. And I hope you found this useful. Do drop any criticism you've got in the comments or questions. I'll be happy to receive them and help out. Thank you for watching. Like and subscribe. Oh, you're still here. Bonus for those that stick around until the end. Wicks are known as a sign of rejection, but they are also considered imbalanced, such as this one right here. While we see it as a wick on a higher time frame, on a lower time frame, a wick it's an A or V formation, and on the right side of the wick there will always be an imbalance because those are strong moves where price suddenly jumps and then returns back to the initial start, such as in this case. This is a massive wick that we saw on the 1 hour time frame, while here we can see it as an A formation pattern. Wicks are good points of interest, and as with any imbalance, it doesn't need to get filled all the way. In this case, we've got a pretty good fill of the wick, and as you can use it as a point of interest, you can target about half of it on a higher time frame. If we would measure it with a Fibonacci tool, we can target close to 50% of the wick on the higher time frame and get a pretty good risk to reward. This is known as WICKFILL, and I'll be talking about it in the next video. Cheers!